So I think I'll get things started off today, just to talk about the mission and the vision of why we're all here. Essentially, this room is full of several different professionals, and all of us are striving to do what's best for the client. We're all trying to know and understand what it is as far as options that they have available to them that maybe other people are not telling them. And so we're here to demystify what some of those options are. And occasionally we have a specific topic. And occasionally we kind of just jump on topics that come from the audience and from the group. And we do that so that this isn't like a canned presentation. This isn't something that's rehearsed. This is knowledge that I've been able to acquire because of my experiences and my resources, some of which have been rather extreme. And so I like to say I'm just an ordinary guy that's had an extraordinary experience. And I like to share that experience with other professionals so that they can better serve their clients. And so with that being said, one of my experiences, I was able to consult with a national coaching, mentoring, consulting firm that had over 10,000 CPA firm owners as subscribers. And I was assigned to the top 400 of that group, the top 400 that paid $50,000 and higher in dues and fees. And I was one of 8 instructors. And I did joint presentation with another individual. And these joint presentations, we had to answer questions from all over the country from these CPA firm owners. We had to help them know and understand what products, financial products in nature, or what strategies, which could be tax strategies in nature, which ones were good, which ones were questionable. And of course, sometimes there are strategies that sometimes work and sometimes do not, based on how people implement them. So then we had to come up with or establish a best practice of how to implement these strategies correctly. Any strategy that has been done thousands upon tens of thousands upon hundreds of thousands of times across the country before the IRS has been looked at or reviewed or been tested by the IRS. Sometimes it gets disallowed. Sometimes it gets allowed. And so how do we know when and how to do things in the most favorable way for the client? On a very rare occasion, very rare, there are strategies out there that have been tested or that the IRS has reviewed them and that they have a perfect track record with the IRS. I'm only familiar with 2 of those strategies. Out of 423 different items that we reviewed with this very large consulting firm for these CPA firm owners, only 2 came out of that as a 100% track record. And those 2 came out of it like that because, well, they were basically copyrighted or patented by the firms that administered them. And so they were very well protected. And yes, there are thousands upon thousands of them. And because there are so many, the IRS, I mean, simply if they just choose somebody's name out of a hat, 1 out of 2,000 people, they're bound to find somebody doing that strategy, right? Anyway, so some of the things that we bring and that, because of that experience of mine that I'm bringing to this forum for everybody, and we're broadcasting live today on Facebook, are things that can help other consultants, other strategists, as well as business owners in general, be able to find what we call deferrals, deductions, or exemptions, and know how to properly implement them in such a way that they should have a favorable outcome with the IRS. Now, I say with the IRS, because oftentimes we're moving money from column A to column B, and we're finding some arbitrage. We're recharacterizing the tax status of that money over time, or we're able to take control over the timing of when that money can be taxed so that additional strategies can be brought to the table to offset or mitigate an otherwise taxable transaction. Now, that's very high level. We have a number of people here in the group, and I'd like to take just one moment while we're here recording and broadcasting. If everybody would just here on Zoom, I know we've got some other people watching on Facebook. In order to participate, you have to be here on Zoom. But I'm able to take questions from both Facebook and Zoom, and I'll be watching both of my monitors. So if you see me looking to the side, that's because I'm looking at Facebook. First and foremost, Adam, I know that you've already said hello, and we were testing your speakers, but would you tell us who you're with and how you're here today and how you heard about us?
I'm with Bennett Financials, and then my boss, Aaron, is the one who I've been attending these now probably off and on for 2 months as I can. So that's who I am and where I'm at.
Very good. Now, tell us what industry you're in.
Tax planning, tax prep.
Very good. And what is your specialty? I mean, you're more on the prep side or on the planning side?
A little bit of everything. As my official title would be junior CFO. So I'm still in the learning and getting down with the nitty-gritty phase.
And what in the last 2 months has been the most important thing that you've learned from these meetings?
You like to call on me because I take notes. That's what I've learned the most out of this.
Well, and I call on you, so then you actually take even better notes, right?
Mm-hmm.
Okay, well, very good. Well, I appreciate that. Now we're gonna go over to the lunching Newtons, and if you'll introduce yourself, Brian and Brennan.
Yeah, we're Brian and Brennan. We're the lunch eating duo over here. Now we've had a business together for a while. We're part of Alphi now. Just rocking and rolling. Got a good book of clients who are kind of small business owners or doctors, dentists, that kind of thing. And we're extremely busy doing a lot of things for them now that we are doing all their taxes and tax planning and all that. So
very good. Taxes and tax planning, investments, insurances, benefits, legal services. Under the umbrella of Alphi, there's a whole menu, a number of different professionals that you guys can call on, but you are the strategists that maintain the client relationship and help coordinate all the other services and specialists, right?
Absolutely.
Yeah. And of course, you are avid sports fans, and
accurate.
All of those musicians and artists that I have no idea how to even pronounce their names. You guys are very familiar with them as well.
A little more familiar than you are. Yes.
Yeah. Yes.
But all equally awkward at the club.
Yeah.
Of course. We'll talk about how they thought we were the FBI later. Mark, can you tell us where you're calling in from and how you got introduced to us? I believe by Dave Bush here on the call, and maybe one of the most interesting things that you've learned from these calls.
I'm Mark Blackton. I do business valuations and transition services for people, helping them, get out of their business at an appropriate time. Yes, I've met through Dave and Elliot, and I really appreciate being included on these calls. Overall, between my interaction with Dave and these calls, I've just learned how creative the group is that you have to work with, which I really appreciate. Dave and Elliot and some of your other people came up with a strategy to roll out or reorganize one of my clients that I would have never thought of. It's just sort of outside the box, but I think it's really a good deal. So overall, I just like being able to ask questions about the strategies that you have and listen to what you guys are talking about. And I really appreciate being included.
Very good. Well, thank you, Mark. Of course. And as you have questions and different things, feel free to keep emailing them over, and we'll try to touch on those topics as we go through these courses. Shane, will you say hello and tell us maybe what you find most important out of these meetings?
Yeah, my name is Shane Kelly. I'm also with Alphi as a strategic advisor or financial advisor. For me, what I find the most beneficial out of these is learning how to explain these things to clients in a way that will help them quickly grasp these strategies to help with their business and to help them with their taxes. So I think the value of these meetings is we're growing and learning more and more how to very succinctly and easily explain this to people who are not familiar with it, so they can understand it quickly, grasp the concepts, and we can show them how influential and beneficial it can be for their business and their lives.
Wonderful. Appreciate that, Shane. We have S. Killer here. I'm not sure if I know who that is. Your mic was on earlier. If you want to say hello, feel free. If you don't, that's okay as well. While we're waiting for them, Dave, if you'll go ahead and say hello and introduce yourself.
Yeah, thank you, Jake. My name is Dave Bush, and I've been with Alpha for 3 years. I've been a financial advisor for since 2008, so it's been quite a while. I joined Alpha because of the various aspects that we cover. Jake did a good job of talking about. We've created a group of professionals that is a one-stop shop. And I've got to admit, it has been one of the more rewarding experiences in this profession over the last 3 years to be able to help grow things out. But enjoy working with Mark and everyone here. Haven't worked with some folks that are on the call or on the web from Facebook, but my whole focus is to be able to learn as much as I can and help my clients as much as possible.
Okay. Well, very good. All right. Well, we're going to discuss a deal story of the week real fast so that people can kind of get an understanding of who we help and what we do for them. In fact, I think what we'll do is we'll talk about two of them. We'll talk about a kind of a normal everyday type of deal where we have a real estate syndicator. A real estate syndicator who came to the table and said, hey, you know what? I heard from one of your other clients that you guys could help me out because every time I buy and sell a piece of real estate, I lose a big chunk of my portfolio to taxes. All right. Well, what do you have going on, etc.? Essentially, they have this amazing opportunity to sell when the price is right, which is right now. And they're going to get the price that they want. They have some limited partners. They have some general partners. And not everybody wants to do the same thing on the after the sell or during the sell or with the proceeds of the sell. And so a 1031 really doesn't work for them, as well as they don't have another property ready to go for the proceeds. So literally, unless all of the participants use a 1031, they can't do a 1031. And if they don't have another property identified within 45 days, and then, within 180 days do, move the funds over and purchase the property, then it won't work. However, we presented to them a business trust, and he said, hey, I know one of your other clients has done this, a friend of mine, another syndicator. And we were able to help him in a similar fashion. We're actually getting ready for the close next week. Everything is lined up and ready to go to where they can actually roll kind of like a 1031 without the limits and barriers of the 1031. We're able for him as a general partner and the majority shareholder able to, or I guess partner anyway, in this limited general partnership, we're able to roll over his basis. We're able to roll over the cash, and we're able to then reinvest it in more real estate as we go forward, as he's a constant syndicator. This is very helpful because some of the limited partners want to just cash in, pay the taxes, and move out of real estate altogether. And so this helps accomplish the goals for everybody because every single household can choose to do their own thing, and everybody's happy at the end of the day. So that's one deal close story of the week. I say deal close because the attorney's got their part done, the trustee has their part done, the financial advisor has their part done, and it's all ready to go for escrow next week. And it's pretty much going to happen. The other deal story of the week, we have a little old lady who's 79 years old, and she has 5 rental properties and wishes to sell 2 of those 5. She wants to continue to have income and revenue from those properties or from the proceeds of those properties. But she's just tired of maintaining them. She's 79 years old. It's really hard to be a landlord sometimes. So as a solution to this, we are going to do a 1031 exchange, but we're going to do it into a Delaware Statutory Trust Fund. A Delaware Statutory Trust Fund is a portfolio of like-kind assets and is eligible for a 1031 exchange. And this allows her, as we are able to go out and find a portfolio that provides her similar income to what her rentals currently provide her now, it allows her to do a couple different things. First and foremost, she's able to roll it all over and have it be a non-taxable transaction. And the second thing, she's able to maintain the income level that she's accustomed to. The third thing is that she no longer has to be the landlord herself. So she's able to simplify her life and help prepare her estate for should she pass away in the next 5 or 6 years. And so we've been able to accomplish those goals and objectives for this client. The client did not come to us and say, hey, I want a Delaware Statutory Trust Fund. Client came to us and said, hey, I'm going to sell these 2 properties, and I know I'm going to spend a lot of money in taxes. What are my options? And so that's what we do is we help establish an array of options that work for the client's scenario, and we try to provide a recommendation based on their desires and objectives, what would be the best possible synergistic outcome for what they're trying to do and accomplish. And usually these conversations are over a number of weeks as we get to know the client and really understand what they're hoping to accomplish. Sometimes, though, as Brian and Brandon can attest, a client's deal or their taxable transaction is coming up very shortly. And I believe there was a syndication in which Brian and Brandon were assisting as strategists. And from the day that we brought all the people to the table, Brian and Brandon, how long did it take for those 2 syndicators to essentially get everything done so that they could close on those real estate properties without having it become a taxable transaction for 2022?
We think like 5-6 days, something along those lines.
Including weekend
Yeah, including the weekend. So
So the client had urgency and you were there to quarterback all of the specialists and all of the services. And, I don't think it would have happened if it weren't for you guys. But essentially, we were able to get everything done within 5 or 6 days.
yeah, Jake, and if you're finding people that aren't doing it last minute, let me know where those people are. Because everyone that we talk to, it's I close in like 2 weeks or so.
Fortunately, there's a lot of individuals, and I want to say that Adam and his boss, Aaron, have sent us over a number of people that are planning for big transactions in the fall. And that gives us ample time to prepare and to discuss and really, get to know them and their goals and objectives and make sure that we're providing them truly with all of the options available. And I'm thinking of one client in particular, and we might actually invite Aaron on the call maybe in the future to discuss this client as we get closer to the deal date, so to speak. And so whether it is imminent, which as you mentioned, Brian and Brent, a lot of times people come for advice last minute when they should have been planning on it 2 or 3 months ago, or whether they are able to plan on it 2 or 3 months down the road, it is imperative, and I say imperative, if the tax pain is significant enough, and some of these deal sizes of $1 million or more, you're looking at $2 to $3 to $4 to $500,000 in taxes, depending on their state. Then it's definitely worth having a discussion. Right now, I would like to give everyone here an opportunity. I have a full list of things that I could discuss and talk about over the next 30 minutes or so. But I would like to know if there's any questions with people who currently have clients that they're working on right now. Any questions that you'd like to discuss amongst the group to see if it doesn't also benefit somebody else to hear the same question. But ideally, multiple people here can help answer and provide their input based on a client scenario. I would like maybe go ahead.
Hey, we got something.
Question.
Yeah.
You, I'm sure, know the answer. So we have a business owner who is bringing on a minority partner. They're going to be giving them, as part of compensation, 1% of the business in the first year, and then it'll be progressing up to 10 over probably the next 5 years. Is there a way to give them that 1% as a gift to avoid taxation on the person receiving that 1%? The estimated value of that share of that 1% of the company would be maybe $10,000, call it.
All right. So every year there is a gift exclusion, and it was 15,000. Let me see if they ratcheted it up.
It's 16,000 now.
So if it's 16,000 per person, that gift exclusion, if the individual giving the gift is also married, husband and wife may both give a gift based on household earnings or household assets, right? Mm-hmm. So depending on the state that they live in, or depending on if there's a prenup or any of that stuff in place, it is possible that husband and wife who own the company, husband owns the company, but depending on the state, if it's husband and wife that technically own the company, they could together collaboratively give $32,000 worth of whatever. Okay. Cash or stock or what have you. They could be giving that to this junior partner. Perfect. That's all. That's what I had mapped out and planned on. I just wanted to hear it from you, so I can. Well, and you can. Yes, I can blame Jake if it goes awry. And you can do that without even having to file a gift tax return. Yeah. Should you start superseding those numbers, there are other methods of still giving gifts, but then they require that you file a gift tax return in addition to that. Yeah.
Some of the business have to file something.
You just have to file something to transfer the actual ownership, right?
So there's also with the articles, and so operating agreement, shareholder agreement, what have you, depending on the type of entity that it is. You do have to adjust those representing the share that is being provided to the individual, and you would have to show the value of what is being given. Okay. And that is fine. And if this company doesn't have a true business valuation, do they need to have something, or can they just come up with, hey, this is our profit or this is our revenue, and we're going to go off of this to determine a value? Because it is a small entity and it's not a public entity, there are no requirements that there be an actual business valuation, but it should be justified. Yeah. And what does that mean? So you have to provide some kind of formula or some kind of reason for why the two parties mutually agree that it's valued at X. Okay.
Perfect. So we can run whatever here. It's off of,
You could do a
Sometimes-
multiple, you could do
Yeah.
gross income, you could do EBITDA, you could do any of these normal methods of valuations, which Mark, I'd like you to pine in on this here in just a minute. But as long as it's mutually agreed upon by the two parties involved, it should be sufficient for a small business stock ownership gift. Now, Mark, can you
No, I agree with what you just said. If it's small, it's never going to be audited. I mean, let's be honest, and as long as it's reasonable, I'm good.
Yeah.
But I did have a concern. I've seen these small percentage ownerships of businesses only leading to nothing but nightmares in my life. And I want to ask why you want to give this stock away. Maybe you could find some kind of synthetic way to get to the same benefits and not create this, because these guys have a fight in 3 weeks and now you're unwinding it, or a year and a half, and it's usually pretty painful to value that stock at that time, because now you have contentious parties.
Yeah, so in any type of business transaction, there are people who get along and there are people who do not. And as you mentioned, Mark, sometimes you are setting yourself up for future problems. And sometimes people too freely give away business ownership. It can also be a good thing, though, in the fact that it's forcing people who might be critical to the outcome of the company, such as a junior partner. It's forcing the senior partner and the junior partner to agree on the financial health of the company, or at least be transparent about it, because now they both become either partners or shareholders in the same company. And so it almost, and you and I and everyone here, we all know the small business owners are not always the most organized, not always the most prepared, and not always the most financially astute. This does become a more costly venture because now we have somebody else involved in the family business who's not family, that even though they may have no voice or control over the company, we still have to report to them as an owner the financial status of everything, and they now have a say. Should I take that personal expense as a company expense, or should I not, what have you, right? So there's more people you bring to the table that have to mutually agree. However, under certain scenarios, and there's the ESOP plans, and there's all these other things where people can invest in and everything else. It's also not all that uncommon to provide as an incentive based on performance, instead of a big commission or, some big bonus, to receive ownership in lieu of, or to have that ownership be the dangling carrot out in front of the individual to make sure that they, one, golden handcuffs, they stick around. Two, that they aren't just punching the time clock, that they're actually there for the overall results of the company.
Yeah, let me add some context to it. So it's a sister bringing in her younger sister as a business partner. Whereas if she doesn't have any ownership of the company, right, she doesn't have that, she can get compensated for the growth of the company. But if the company grows to $5 million and goes to sell, she wants to be a part of that. Both of them want to have that relationship where they're both benefiting from it. And it's structured in a way that it's the younger sister is going to be compensated in pieces of the company as the company grows. But yeah, if they decide that after a year they don't want to do it at all, then the younger sister is going to have 1% of the company. And then you can untangle that. She can pay for the percentage of the ownership. But
So
let me chime in real quickly on the value thing again, because as you were talking, I thought about this. You realize that when you do a fair market value of a business, there are discounts for lack of marketability and control.
Mhm.
So a lot of times you'll see, it's fine, we do this value, and nobody thinks about that because you don't need a qualified value. But then they get into some kind of a disagreement, and the controlling shareholder comes in and says, oh yeah, it's only worth 50% of the real value, and that's all I'm going to pay you when we unwind this. So you often will see in a family situation where you define how that valuation is going to be done in the future in the case of a change of hands back.
yeah, so basically coming up with an agreed upon valuation that you hold to, even if they decide to split ways, so that you're not going back and forth.
And specifically excluding those discounts is often done
Okay.
in a family situation. All right,
Perfect.
that's all I have to say.
No, good. No, it's good to know.
Wonderful. No, I appreciate that. Now, if I might just add a few more things to that. So Mark has a really important point that he made earlier on in this process, they should definitely detail out, and Brennan, you were actually touching on this a little bit. So performance-based, or is it over time? There needs to be the metrics of how and why additional percentages are added over what period of time or what milestones, right?
Yep. And right now Jake. So we have it structured that over the next 5 years, they'll get a percent over every year that they're still with the company. And then every $250,000 in revenue growth from the certain start date, they will get an additional percentage for each $250,000 up to 10% total. So there's a time component, and then there's also a revenue growth component.
And does the revenue growth need to be tied directly to that sister, the younger sister, or is it just
the business overall?
Okay.
Yeah.
And should the younger sister no longer want to participate, is there some kind of buyback or gift back mechanism to get her shares back?
Nope. And that's where where Mark was talking about, you need to add in the stipulation, hey, this is how we're going to value the company in the event of a dissolving partnership.
Now, that could also be a hardship on the primary owning sister. She may not have the cash flow to do an immediate buyout, so you should have some kind of time period that is reasonable established to be able to pay that back, or do it in installments or something of that nature.
Like put a time window on it.
Well, you can actually put in that it can be financed over a long period of time. I mean, if this person's leaving, there's no real good reason to be the older sister's not going to be caring about being that nice to them. So you can put in some pretty long-term hold financing provisions in that kind of arrangement. So you can calculate it. This is how we calculate it, and then I can pay you over 5 years at, whatever.
Yeah.
Okay, so I have a Facebook comment, and I'd like to hear what everybody else here in the room would do, and that includes you, Adam, and Dave Bush. I want to hear what you would say. So let's go with Adam and then Dave Bush. We have a client who owns a service business, and this service business, they're looking to sell it for $250,000. So it's a sell. It's not incredibly big, but what would we do as far as, Adam, you have an interesting look at this because you're kind of a junior CFO, but then you guys also do tax planning. So I guess first and foremost, what would you do to organize and help them so that they could become ready to sell? And then second, what would you do on a deal size of this smaller amount, $250,000? What would you advise them on?
So we currently have a roadmap matrix, I guess, questionnaire that we ask our clients to. We essentially look at the 1 year, the 3 year, so on and so forth. But the roadmap gives us a good showing of if they were to sell tomorrow, what their current value would be versus future value as well. I would plug that in and show them that 250 is kind of from a personal standpoint. I don't know if 250 is worth it versus sitting on it and trying to get the business to grow. I mean, most of our clients are either well above that or they're probably not going to make it in the long run right now.
Would you say that a lot of people in that range, sometimes they just let their businesses go rather than selling them, or they bring on a successor?
I can see both sides of the coin where like you're frustrated with it, tired of walking, and you just want to walk away with a little bit of cash. But I know in today's world, 250 that's not a lot of cash in that standpoint. So it really depends on what is their true end goal of do they just want to walk away, or are they really trying to make something, get a decent chunk of change out of this?
So let's say that, so adding to this a little bit, it actually doesn't take the owners a lot of time, but let's say for health reasons, they have to stop. And so their choices are let the business die or sell it, which of course they'd like to get something out of it. It produces $11,000, $12,000 a month. So what they're asking for is roughly 2 years of revenue with zero operating costs. There's got to be operating costs in there somewhere, but let's just say they're pretty light. So Dave, you've been working with a ton of business owners who are looking at selling their businesses. Most all of them are higher in value. So you and Adam might have a similar opinion on this. But what would you say in regards to advising this client? And then Adam and Dave, you guys can talk back and forth, but like, what would be some things that you could do should they have to sell this business now?
I was going to defer to Adam. I think the beginning piece would be understanding more of what other assets they have, what other things are coming into play. It would also I would also want to take a close look about how much they need to live in their future retirement or the type of things they're going to be doing. So it's just a simple basic analysis in regards to how much do they make or how much income do they have coming in, what resources are they coming from, and then how much do they need to live. And the starting point would be based on where they're currently at in regards to their expenses. So I would begin there. I would also want to review any wills or trusts. I mean, there's a variety of different pieces so that we would understand better what their overall position is. From using a doctor's analogy, somebody comes in with a fever. I need to know a heck of a lot more before I say, oh, just take some aspirins and go home.
Very good. Very good. Actually, you're heading in the right direction where I want things to go. And let me explain. A lot of times people come to us because of one thing. And again, if we use the patient and doctor analogy, what if it's deferred pain? Deferred pain, or that's very common in the dental world. This tooth hurts, but the problem is actually over here, but this tooth hurts, right?
Right.
So when people come to us and usually there's a pain point, there's the hot button, there's something very specific they're coming for. And yes, of course, we have to give them attention to that. But then as you mentioned in this scenario, so they want to sell the business. They have some reason or purpose why they want to sell the business now. But one of the things that I love that a lot of accountants miss is cash flow. So if they currently make $11,000 to $12,000 a month now, and they're only going to get 2 years of income out of the sale of the deal, well, are they now turning age for Social Security? Or do they have other pensions and assets? So you talked about what else do they have financially going on? And we need to review the overall scenario so that we can maybe help them. From a tax consequence, can we provide them advice on how to structure the deal? Should we just recommend a common installment sell? I mean, right now they're getting ready. If they haven't got it listed already, they can talk about how, yeah, they'd like to be bought out, but they would like only so much every year so they don't have to pay taxes and all of it all at once, right? So everybody's scenario, big or small, doesn't always require fancy, elaborate financial products and services, but it requires a financial psychologist or somebody who's willing to dive deep and ask them more than what they're bringing to the table. Kind of like a doctor or a dentist, if the pain is here, but the problem is over here, how do they decipher that? And it's not that I naturally don't believe people in what they say, but a lot of times people aren't telling you everything, or they just don't recognize what they're not telling you themselves. And so they might be coming to the table today wanting to sell. Now that going back to one of the things that Adam said in the very beginning, well, does it make more sense to sell now at such a low price? Or are there things from a CFO standpoint that we can do? Instead of a 2 times multiple, we can make your business get a 3 times multiple. Are there some inefficiencies that we could work through? And could we actually grow the revenue over time? Do you need a better marketing plan? And perhaps the individual's just frustrated. And if you can help solve their frustrations from a business management standpoint, then maybe they don't even have to sell, right? And Aaron and Adam's firm, they're phenomenal at helping people's businesses go from here to here. And that's what they do, is they help people grow businesses to sell them. And so they might be a little bit extreme on that side of things, because that's the clients that they cater to, and that's perfectly fine. And that might be exactly what this client is. Anyway, so I like the comments. This was a fun dialogue, and we got to see it from limited information. We got to see the viewpoints of 2 different people, and then me adding my conjecture in between. It was kind of fun. Any other comments there, Adam or Dave?
I know one of the other options that we would potentially present is if they're making that 11, 12, 13,000 a month, whatever, what about putting somebody in place? And that way you can just literally sit on your rear and so you're not going to make as much at the end of the day, but you're still going to get that constant cash flow like that. So it really depends on where they're at in life and what their like Dave was saying, like, do they have other sources of income, or is this the only thing they have? And if this is the only thing they have, they're fine with, not everybody's big and greedy on what their monthly money they really need. Some people just need $3,500 a month and they're fine for life. So it just depends on where they're at. There's a few different circumstantial questions, but like if like a 250K cash out's great, but I would rather, I would try to convince them on the other hand of looking at the other side of the coin of just sitting there and paying somebody else to run the business and potentially work on improving it from that route.
Well, and again, from a masterful approach of helping companies that are this big grow to this big or to scale and everything else, a lot of times that has to do with hiring the right people. If time is an issue, how do you free up your time? If you're dedicating your time to the wrong things, instead of working on your business, you're way too busy working inside of the business. So how do you extricate yourself, replace yourself, and then build and scale, right? So definitely some CFO type conversations, some financial strategy type conversations that this individual could have to help establish, first and foremost, is selling now the best thing? And then, of course, if it has to be sold now, how do we mitigate those tax ramifications the very best that we can? And what other assets? So what are the overall goals? Just selling the business, but you're accustomed to the income. Does selling the business now present other problems? We're going to lose that income stream unless we replace it somehow or have other income sources. And so this is why we're here today, because sometimes people are very transactional. Somebody walks through the door, they say they want X, and we give them X. When in reality, it was deferred pain. They didn't really need X done. They're going to be upset because we didn't ask them the right questions or whatever. So it's the difference between transactional people and somebody who is truly an advisor, somebody who asks the right questions.
And that's one of the things that Aaron forces us to look at with our clients is what, at the end of the day, what do they want? What's the 1 year, 3 year, 5 year, 10-year plan? And we kind of stick to this roadmap from day one with them of looking at the plan and going from there.
Very good. Well, all right. Well, maybe next time when Aaron joins us so that we can talk about that particular client that I have in mind, maybe it would be kind of fun if you and Aaron presented this roadmap. I know that Brian and Brennan have been presenting a roadmap of sorts to some of their clients. And I believe it's probably very different than you guys from the CFO standpoint. And I think it might be kind of intriguing for the whole group to see a comparison of the two. So maybe give him a heads up and see if he's willing to do that.
Yeah, I'll run it by Aaron.
Yeah. So that was kind of fun. And that actually happened. Like I'm getting more and more comments from this person as we're talking through Facebook. So kind of exciting and fun to have somebody participate live, even if they're not here talking to us in person. Let's see. Shane, do you have a new client from the last 2 weeks or so that you'd be willing to talk about their scenario without using their name?
Well, it's funny you mentioned that because as you've been talking, you have this client in mind that that sounds so familiar to what we're talking about. He has some real estate properties he's looking to sell. They're not worth a heck of a lot, but he also has a business he wants to sell later on this year. And so as we've dug more into his plan and got to know his situation, and he wants to retire and kind of pull all his irons out of the fire, he's got several different projects going at the same time. He's like many entrepreneurs do. They don't just do one thing, they do several things, right? And so as we were looking at all this initially, the deferred sales trust didn't make any sense with the sale of these two small properties. But as we looked into more of what he's looking to do down the road, and by that I mean within the 1 calendar year, selling his business, it definitely does make sense. So that's something that I think, to your point, getting to know our clients well and knowing what they really are after is the right way to be a good fiduciary and to serve them the best that they need.
Absolutely. Very good. All right. Adam, I don't think I've asked you to share a client scenario before. I don't know if you received the new clients to review and analyze or not, but if you have somebody in the last 2 weeks that you'd like to share their scenario and get feedback from others in the group, you're welcome to do so, and I'd love to hear it.
We have a newer client he's in the coaching level and very laid back. Between the first interaction I had with him and the second one, his problem is that he's just dragging his feet about everything. the very first meeting he had, he was very much big on what he wants for the 1 year, the 5 year, the 10 year. And then since then, it's been a little touch and go of, oh, hey, we need you to open QuickBooks. We need you to do these, follow these steps, do these 3 or 4 things. But I haven't seen a lot of the other new, that's really it for the new clients. Right now, it's just mainly just kind of covering some of the meetings for Aaron, because I know he was sick today, and then getting my own book of clients and just getting more familiar with what they want and where they're at. That's kind of where I'm at right now.
So your client sounds like a client that it brought to mind a client that actually appeared on TED Talks. That was a referral from a CPA in California. And this client, also a consultant that appeared on TED Talk, just a phenomenal individual. Again, I won't say that she is the type that drags her feet, but what made me think of it was the relevancy and the importance to call her to action. So sometimes people don't understand the importance of maybe not dragging their feet or, not spending time in other areas until they understand the dollar significance. And this individual, we did a restricted property trust. We did an 831B. We did, what else did we do? We set up some other things, such as how to pay your kids through your business and the Augusta rule. All right. So at the end of the day, when we showed her how she could save, how right now as consultants or as coaches or people that largely receive a lot of revenue, then they don't have a lot of offsets. We were able to show this individual how they could pay around $300,000 less in taxes. And at that point, it became very relevant. And usually, sometimes we get so stuck in the process, the journey, the roadmap, that we forget that some of these clients need, what are those machines when you put on someone to resuscitate them? They need a little shock, right? They need to be brought back to life, or they need to be awoken to realize that if they just continue down the road, everyday life as they are right now, then they'll continue paying that extra $300,000 that is needless to be paid. And that's not very efficient. Should they be able to reinvest that money and help grow outside assets and all these other things that we help people do, right? Anyway, it just made me remember that client. And I said from a year ago, I think it's actually been longer, probably about 20 months ago, helped this individual. And very fast-paced moving person, very energetic, but just running because she's making all this money and she knows that she's got to pay so much in tax, and she just didn't realize that she could be saving so much. And so then we changed the conversation from income and cash flow to tax flow, and how some of that tax flow could be diverted into building other assets for her while getting deductions at the same time. And that made a big difference in her way of thinking. She completely altered and reprioritized, and we became very important to her.
And we're right at the cusp of that, because Aaron is very big on, we use ClickUp as our information management system. So he's very big on the timelines, like client signs a contract. We've got 7 days to do the kickoff call. We've got, so many days after that for the tax planning questionnaire, and then just get a better feel for what do they want in life? What's their end goals? And so we're right there with this client of just trying to get him just to go ahead and book that call so we can really get the ball rolling on a lot of these.
And being super organized for clients who need that specifically is incredibly important. They expect it from their advisors more so than from themselves. And if you can train them to be that way by providing them the format, the outline, the roadmap, that's great. Now we got a question. Candace, can you go ahead and chime in? And I don't know if the question is for me or for Adam, but let's hear it. Oh, it looks like she's also multitasking. There we go.
I had a question. So you mentioned paying your children. I wanted to know about gifting appreciating assets to either children or a charity.
Wonderful question. So in the United States, I say this because I know that you're Canadian living in Mexico. So in the United States, it is very common for somebody with a highly appreciated asset to gift it to a charity, because then they don't have to pay the capital gains on that asset. Now, depending on what kind of asset it is, it could be a cash or a non-cash contribution, which has different thresholds and different rules. So if it's a piece of real estate, it's going to be treated a little bit different than if it's a cash or cash equivalent asset like a stock. Here in Utah.
Client in question, it would be a cash asset.
Okay. So here in Utah, it is very common for people who have owned, let's say, Apple for 20 years. They might have bought Apple for $20. Apple might be selling at who knows what it's selling for after all the stock splits and different things. I mean, it could be selling for an equivalent of, 700 or 2,000 or whatever. I say an equivalent because of all the splits. They then receive more shares. So if you were to dial it back into the same number of shares they originally bought, there's a huge gain on what that stock could have become. And if they were to sell it and then donate the money, they would pay taxes on what they sold it for. But if they just take that stock certificate or the digital stock itself and transfer that to the charity, they get the deduction of the fair market value. And here's the arbitrage. They don't have to pay any of the taxes on the growth. They get the full deduction of the today's value of whatever fair market value that stock or cash equivalent has appreciated to, without having to pay the taxes on the growth.
Okay, that's amazing. And now earlier you had mentioned about the husband and wife gifting another husband and wife. I'm curious how income splitting for private corporation business earnings between adult family household members goes.
So again, it comes back to, let me paint a couple scenarios. Well, Adam, are you married?
Not that I'm currently aware of.
Hopefully, if somebody's married to you, they let you know. All right.
Stranger things have happened.
So this is a good example. Adam is a household of one, unless he's got a dog or a fish or something. But for legal stand purposes, animals don't count. Adam can give up to the 16,000 to anybody. In fact, he can give 16,000 to lots of people. Only up to 16,000 per person, though. Adam, if he wanted to give more to a husband and wife who are legally married, and it doesn't matter if they're separated or any of that other stuff. It's like if they're legally married, he can give 16,000 per person. So he could give 16,000 to a husband, 16,000 to wife, but Adam can only give up to 16 because his household is only of one adult. In a different situation, Shane is married. So Shane and his wife can both give 16,000 to one person, or Shane and his wife can give 16,000 to two people. So if Shane wanted to give Brennan 16,000, he could do that. Shane and Shane's wife could give Brennan 32,000. Shane and Shane's wife could give Brennan and Brennan's wife 32,000 each, or for a total of 64. And Shane, I'm sure Brennan would be happy.
Hey, Shane,
Probably
come home. You can make it out, Brennan Newton.
Yep. Ready to go. Write the check, right?
I'm ready.
There you go.
Yeah, just write a little gift on the bottom.
Now, again, if we're giving something other than cash or cash equivalent, that it isn't easily decided on what fair market value is, you have to have some kind of mutually agreed upon whatever. That gets a little bit more complicated and possibly could be contested. But usually, as long as you have some kind of agreed upon valuation of what that is, and then, of course, as Mark was bringing up, if it's a business interest and it's closely held, because of marketability reasons, you could actually devalue it or discount it down based on what the numbers show could be fair market value. Mark, do you want to touch on that just a little bit?
Well, I think that's interesting, and you're right, the valuation's always an issue, but usually if you're giving small business assets or ownership to a trust or a charity, you have to find an intermediary to handle that complex. They call it a complex asset. There's a couple people here in Kansas, groups that do that in Kansas City, and because they do so much of that, they really do.
For closely held company. Publicly held is easy.
Right.
Closely held, where it gets a little bit stickier and we're talking higher dollar amounts. Yes.
Right. It has to be, so I had a meeting with a potential client just last week, and that really got their attention because they have a charity that they're interested in. Their company is growing in value. We may be looking at bringing that to Alphi to do the tax planning around a significant $1 million gift to a charity at current value, which again allows these people in the next 3 to 4 years to sell and not pay capital gains on their closely held company.
Well, very good. All right. Well, I think that's everything for today. Unless somebody has one final question, we have maybe just 2 minutes, but if not, I'd like to kind of let everybody get on to the next meeting with some time to prepare. And very happy, very, very thankful for all the questions and comments and everybody who participated. Next week, we have an exciting guest speaker. And I'm not going to tell you who it is right now. We're going to put it out in a publication, so check for who that's going to be. And we're going to be talking about some very good topics that relate to every business owner making around $500,000 or higher. So be sure to show up next week for some of that fun stuff. And for more information based on what we're sharing here today, this is going to be on the YouTube channel that I have, as well as on the website so that people can go in and view it later. Or if there was a spot that you'd like to rewind, so to speak, or watch at 2 times speed, what have you, it's going to be recorded and posted for you to be able to do that. All right. Well, thanks everyone. Have a great day. And again, thanks for participating. We'll see you later.
Okay, bye.
Bye.